Hello, John.
Hi guys.
I can.
Can you hear me?
I can hear you. Yeah.
I can't hear you too well. Hang on.
There we go.
How are you doing, John?
All right, thank you.
There we are. It's better.
Life on the other side, okay.
Different.
Well, what are you doing now, John?
Just basically running a small IFA with regard to all compliance. So they had a couple of bad experiences, so they pulled me in instead, and I'm able to do it two days a week. So
Right.
suits me fine.
Yeah, sort of a lifestyle thing, and you've certainly had the experience where you've been working. Now, there was that one alteration, Charlie, on the title. The reason being, fixed interest was a very small part of what I was doing.
Okay.
So just for the logistics, when I say next slide, it's going to come up on the screen, Charlie. Is it as now?
Yes, I can be your next slide.
That's it. You got the job. Right. Great. Brilliant. It works.
Which was the slide you changed that one?
Oh, you've done it. That was it. Yeah, that's the only thing that needed doing. Yeah. Okay. Otherwise, I'm following exactly what you've done. Have you got the dogs there? The wood burner going?
Yes.
So you've got an audience.
I probably ought to have some airport music, or
Yeah.
to fill the void now. But yeah, no, it's the new world.
I got a 223-page review on AI this morning from Credit Suisse, and it's written by 40 analyst teams from around the world, and it's exploring every possible growth opportunity because they see it as the biggest thing since I won't say sliced bread, but the growth potential is enormous. It's probably what your IT guy will say as well, but there are different ways to play it investment wise, and also the job implications, of course.
From what I can gather, the size of someone's imagination and their opinions of AI are directly correlated. So that's the impression I've got. I've asked a few people, and I thought, well, I then come to the conclusion that their imagination isn't that good.
Have you experimented with anything on there?
We're in the process of doing it. Yeah. I think it's, unlike you, I think it's bigger than Google.
I think you like most things, I think you need a human sort of final check. But just as an example, a couple of weeks ago, we had the final cross-country match of our Kent cross-country league. And I was the captain of our team, and we were running very well in the league. And one of the chaps said it wrote a poem. It went to about sort of 10 verses, and all he'd written was number one, Beckenham Running Club competing in Kent Cross Country League tomorrow. Number two, Ken and Katie are your captains. Number three, write it in Shakespearean English. And in 30 seconds, this poem came out, which this guy circulated on WhatsApp to all our running team. And it was just amazing. So it brought in all those features. And I've used it as an experiment to partly write an investment, not the conclusion, but the facts on an investment stock. And although some of the data was a bit out of date, that job, which took me about 20 seconds, would have taken 2 hours. So that's just a little example. It's worth playing with and following, I think.
I'm with you all the way. We're looking at it from putting in the fact find information and seeing if it will come up with a report. That's the key. A bit worried about the data protection. But,
yes, there are other sort of issues, security issues, and so on.
But presumably, it's going to start telling us which how to run. What we should have put in before we started, how to run an investment committee, and come up and put the results up as the first slide. Anyway, it's 1 minute past 10, Ken. So shall I if I start?
Yeah, who's in attendance?
Well, we've got however many people.
Dan.
I can't see why I'm sharing the screen.
Nice to see you. Julie, I can't see her, but she's there.
But anyway,
right.
so I've got well, I'm going to say,
Kirsty,
20 or so people. So
okay,
I'm sure a few more to join.
Oh,
So the idea is, if I introduce it, and Ken's going to run the seminar basically, and the idea is that IFAs really should have some sort of structure to their fund management process, and running an investment committee is clearly the ideal way to start. I wouldn't suggest this is everything you do, but it's a start, and you can badge it up, and it gives an opportunity to share information between us all on fund management. It gives you the opportunity to know more about how other people run investment committees, and I think it could be useful. And so we're going to run this quarterly, and see how it goes. If it's successful, we can keep going. And obviously, it's helpful to have some sort of a structure. You know, within a firm, particularly the larger firms, really need some sort of a structure overarching the whole firm as to how they run their investment process. So that's for counterparties. So you know, FCA, people buying a business, customers who are unhappy or want clarification or want verification of what you're doing. That's my spiel. If I move to share screen, I will put on PowerPoint. We're not going to kill you with PowerPoint. I think it's only about 10 or 15.
I'll leave you to the technology, Charlie.
So Ken's got experience in all sectors: investment trusts, life funds, pension funds, private client money, hedge fund, charity money, bespoke portfolios. And I've personally put Ken forward to a number of firms who have said, we want to do the DFM proposition, but without ever having a specific DFM experience. So Ken sat in as non-executive director with a number of firms. And help them get the license, get the experience, and then progress from there with the FCA, and then help them set up this type of structure and push them on to greater things. So anything else you'd like to say, Ken, about your background?
No, it looks a bit heavy, that title. The reason I've put those several fund types will become apparent when we briefly talk about benchmarks at the end. And the other thing is, I'm traditional institutional fund manager background. So I came out of my real core was direct equities, moved into bonds. I worked for an investment trust house, so I know a lot about investment trusts. Unit trusts were relatively new to me when I came into the private client world. And then, of course, more recently, ETFs, commodities, and structured products. So many fund types and many instruments. Let's have a look at the next slide. Before we get on to the process, there were just 3 points I wanted you to keep at the back of your minds when you were writing anything or talking about anything investment-wise. I've been involved with investments since 1976, so over 40 years, and the different fund types and different providers, and I've come to my own conclusion that at all times you want to get back to the real statistics, not a lot of the noise, which it's easy for certain parties, often who have vested interests, in providing. So my degree was actually maths and statistics. So I'm a bit of a numbers man anyway. And risk, return, standard deviations, all this stuff is bread and butter to me. But my point here is, when people are talking about the index return, UK funds, all the rest of it, keep a log of your own statistics. All the data's out there, FT, Telegraph, wherever. Use a spreadsheet, but get the facts, number one. Related to this, number two, with the sort of 24/7 media coverage of everything and everything that feeds onto investment, and there's a lot of it, there's always a lot of noise out there, and that can be legitimate news, but too much of it, or in some cases, bad news. And I think here, for instance, our friend Elon Musk at Tesla tweeting something, or Donald Trump. A, you shouldn't react to this stuff immediately, even if it's true. And B, there's a lot of untruths out there. So again, sit back, think about it, and certainly don't send on false information. Next one. Oh, the risk. Now this is risk within your portfolios, and it doesn't matter what the end package is, whether it's a SIP, an ISA, a dealing fund, whatever. Think of risk as a function of asset allocation. This comes over the long term, the famous cash, UK equities, overseas equities, UK bonds, overseas bonds, and I would classify a growing percentage of what I'd call alternative investments, infrastructure, renewables, quoted vehicles, not stuff is locked in for several years, but think of the asset allocation, look at the individual stocks. Again, the information is free. You don't have to just rely on somebody else's information. Go to the London Stock Exchange pages. All the information is there. Look at the companies, the nature of the holdings. And finally, you have a high risk fund, you have a low risk fund. You've decided you want X in equities. You've decided you want X in, let's say, Legal and General, which is one of the companies I like at the moment. Your low risk fund might have a fully diversified portfolio of 50 holdings, mainly pooled funds, which themselves are a way of reducing risk. Maybe one or two equities. Well, maybe L&G deserves a 1% weighting. Your high risk fund, and I do run some high risk funds of mainly direct holdings, which is my passion, direct equities. Your L&G holding might be 5%. Or if somebody says to me, give me 10 holdings which you would hold for this year, I'd make it 10%. But again, look at the asset allocation, look at the name of the company, look at the size of your position. So I think we're coming to the point now where we're starting to look at the structure of an investment committee. My experience has been a quarterly cycle is very good to review the background information, review what's happened, look at your own positions, look at how they've been affected by what's happened, look at your assumptions going forward and tweak as necessary. It may also be the period at which you, and you're all different on this, you may be talking to clients, sending them out a report. You know, feel free to copy and paste some of my views, but do say, you know, there's 100 views out there. You've all got your own view, but keep that in mind, that background. And the point at the end of that slide was this is a sort of 70-30, 60-40, 80-20 game over the long term. You're never going to get 100% right. And anyone who claims to do that consistently, and we see this time and time and time again with fund performance, it's a very, very, very rare occurrence.
Okay, Ken. So we've divided this seminar up into 4. That's right, isn't it? So
yes, I think.
So I just want to say we're going to spend about 10 to 15 minutes, probably 10 minutes on each of the 4 sections. So we've got market performance, economic review, future strategy, and then the teaching point for the quarter, and at which point we'll probably wrap up.
Correct.
That makes sense. Okay. So questions as we go along. Okay. So if anyone wants to interrupt, just kick in. Okay. And so, we want it to be inclusive. So the first one of the 4 is market performance. Off you go, Ken.
Right. You've all seen that certainly January, and I'm talking about a 2-month period here, was very strong. And all the commentators were saying, equities the best January for grillions of years. Even bonds were strong over that period. And within equities, the higher beta areas, meaning the more highly geared areas, so sort of NASDAQ, for instance, the US tech stocks, very strong. And continental Europe, having been shunned for a lot of last year, bounced into life. If we look at the sector moves, this gives some of the clues. Oil sector was strong. The underlying commodities was strong. Banks was strong. Interest rates were going up and forecast to go up more. This was helping bank margins, more than offsetting risks of defaults and slowing loan and mortgage growth, which is happening now. Telcos, it was one of my value ideas, still is. Apart from the underlying cheapness, we've got state building in British Telecom and Vodafone. So those were expected. There were some that were strong, which were unexpected. And this is where my view may differ with some of you guys. I think the market has been too optimistic on the prospects for the UK consumer, travel, leisure, retailers, and so on. Perhaps I can have your views after we finish this section. The weak sectors, mining, temporarily raw material prices were coming off after the strong advance last year, but they're now putting them on again as China's coming back to life. Fixed interest did have a nice start, and we've had quite a V-shape, January, February. The feeling in January was everything's fine, economic growth okay, inflation coming down, and it's certainly coming down in raw materials, but not in a number of other areas. And that's coming through at this moment, February, March. Interest rate expectations have actually started going up again, and we'll have a graph on this later.
Can I ask a question about fixed interest? So there's a lot of, well, in fact, there's an article in the new FT this morning about all these firms leaving the UK or not listing in the UK, and making the point that pension funds are now just all the defined benefit, huge hundreds of billions, is just invested in fixed interest in order to offset the risk rather than equities. How much of an impact does that have, really?
Right. Well, there have these pension funds and institutions, as you say, over recent years, they've moved more to an asset liability type model, particularly the pension funds, life fund. You know your liabilities down the road, and the only way you can match them with any certainty is government bonds of similar maturity. So they've been pushed into fixed interest products over the last few years.
We know that, Ken, but surely now, having seen a 40% fall last year, surely now they'll be reconsidering that and piling back into equities.
Well, I think that there will be an element of that, and I'll come onto that when we look at the future strategy. But I think a lesson has been learnt. Several models have blown up by this 20 or 30% fall in, for instance, gilts last year. A lesson has been learned by retail investors. A lesson has been learned by institutional investors. But they still have this asset liability issue. And at the end of the day, equities are more risky than gilts.
Yeah, as interest rates go up, bonds go down. I've seen clients who were lifestyled into cautious portfolios, brand new clients, and they've lost 47% the last year for cautious. So anyone investing in bonds at the moment is nuts, and everyone should sell every bond they've got.
But they've already gone down.
Yeah, but they're
going to carry on. Yeah. Do you think interest rates will carry on going up?
Actually, Charlie, if you just flick forward a few graphs to the one about the bond yield, keep going. That was a disaster. Now that one. Now to my colleague there, this is the long UK gilt, 10-year maturity. Now there were two messages here. Anybody who bought in March 2022 was getting into gilts at a yield of 1%. Now, to me, and I've been saying this, actually, I was too early on this because I've been saying this is absolutely crazy. Who would be buying gilts on a 1% yield, number one, when there's huge government supply coming up? Number two, and that's still ongoing. And inflation was at that stage probably 6-7%, rising up to 10%. So it's madness to buy gilts then. Now look at what happened to the yield over the year. This is the UK example. We got to the Truss Kwarteng mini budget.
That's the yield, not the capital value, though.
Sorry, this is the yield. So by then, the capital values, yields going up, capital values are declining all the time, which is what I expected. We got to yield over 4% as people, overseas investors, were saying UK is a high risk place. We want a lot of yield to compensate for that. It wasn't an emerging market status where the yield could have been 10%, 20%, or in Turkey's case, 60%. But we were getting talk of a banana republic, September, October. So that, as you were saying, is a huge capital loss for people who'd invested in March 22. Now we're getting to the situation. So there was a global thing as well as a UK specific disaster and still some UK specific bad news from Brexit and so on. We won't go into that. But the point is 1% at the beginning of the year, 4% then. Yields have come off a bit, but they're coming back to 4%. So my question to you, and some of my cautious clients are saying, well, hang on, buying now, I'm getting nearly 4% on gilts. And if you're in US treasuries, you are getting 4%.
They're going to lose another 20% over the next year if they do that.
Your view. My view is that gilts will be on a total return basis. And remember, you're getting about 4% income. So even if the price loses 10%, you're still going to have a -6 as opposed to -30. Equities, I don't know. I'm not going to say equities are going to fall by 10%, 20%, 30%. But the risk return is very different now if you're starting a holding than it was January 2022.
Okay.
If you
so
flick,
that's where we got diverted from. So
keeping an eye on the time, So the fixed interests have flattened.
Okay.
If you are looking at fixed interest, and there are other ways of playing it. I'll come on to later. FX adjusted, Europe and Japan stand out. Europe as the winner, Japan as the loser the first couple of months. Translating into client performance, probably your own clients, Trustnet, FTSE private client portfolios all show that this year to date, depending on your risk profile, you're up about 3% to 5%. So after the 5 to 10% fall last year, you've recovered half of last year's fall for a balanced client. Okay, that's history. Let's have a look at the news. Economic review.
Yeah.
Right. Economic growth. Probably the estimates reached the trough at the end of the year. GDP estimates. They're getting, shall I say, stabilizing one or two areas slightly up. Reason being, globally, China's coming back into the picture. Europe, not as bad as feared. This is continental Europe. Partly the warmer weather, partly the government help with subsidies. The US is still relatively strong in the consumer sector, and the recent labor figures blew away estimates. Powell is trying to slow that economy. So we've had better than expected economic growth. Inflation, however, at one level, you could say, well, everything's looking a bit better. The headline inflation is coming down, which is true. We shouldn't really boast about UK inflation of 10% compared with 10.5%, but the headline is coming down. But core inflation and labour demands and service inflation, and you may have read the Kantar or BRC figures recently, food inflation is 15%. Core inflation, excluding food, energy, is 5 or 6%. Government targets, remember, are 2%. We're still way above target. Government borrowing is still high in most developed economies. Rishi Sunak may have a bit of money to give away, Hunt rather, March the 15th. But there's an awful lot of borrowing still in place, and it's far too high over the longer term trend. Property prices, sorry?
Is March the 15th, that's the budget day.
Yes, that's the budget day, sorry. Commercial property, we have had a weak experience. Residential property, of course, is starting to come into the figures. We've seen Nationwide, we've seen Halifax, we've seen RICS. Global figures are weakening on a year-to-year basis. We're getting into the negative territory. I'm not expecting a property collapse, but 5–10% could be quite appropriate over the next year or two. House builders have all produced statements recent days, and they're a bit hamstrung in new developments because on the one hand, their customers are facing remortgages, and you saw that long-term graph we showed you earlier. People who got in at 2.5% were having to remortgage at 4%. Another interest rate graph we're showing will show that short-term rates, which their variable rates are based off, will be going up. They'll be going up next month. They'll be going up next quarter. And also the regulation is making it very difficult for house builders to build more. So that subsector is having a hard time. You could argue, well, that's limiting the supply. And in certain areas, supply demand may keep prices up. But across the country, I expect residential prices to come down.
Can you explain the
sorry?
Can you explain the correlation between commercial property and domestic residential?
Well, there's supply demands are completely different, but by commercial property, I'm talking retail developments, which had a very specific factors not in their favor the last few years, including the pandemic. One was actually a move to online. So that affects shopping centres. We've seen Lakeside, Blue Water, Trafford Centre, whatever, declining customers. At the same time, interest rates were going up. So they were squeezed by less shortfall and higher interest rates, the companies that were running these shopping centres. Residential customers are affected by the interest rate bit, but not obviously online selling.
It just interests me that property residential seems to be going up and up. It's up 25% over the last 2 years, but commercial property seems to be going downwards.
Well, I think that there's been a lag, and if you saw the Nationwide figure yesterday, and the previous month, year on year, residential property is now going down. So there's a lag. Property prices are starting to go down. Activity is starting to go down. The RICS figures will show the same. The Halifax Building Society will show the same. The commercial property went through this stage about a year ago because they had different drivers, as I was just explaining. But residential, there are very few reasons, unless you're in a particular supply-demand box, or very high ultra net worth individuals benefiting also from overseas money coming into the UK, for residential properties across the country to go up in the short term. That's my view.
Ken, am I right in thinking the BZW equity gilt fund studies just been is published?
Yes.
Credit Suisse equity gilt fund study has been published.
Yeah. Now this is the Bible, which all you guys refer to in the background. It was BZW when I started my my career. Barclays de Zoet Wed, I suppose it was then. The interesting thing about this study is it's produced by academics, London Business School, LSE, Cambridge University, Marsh, Elroy and Dimpson, the authors. So they don't have a particular commercial axe to grind. They've analysed the data on all world equity markets, bond markets and money markets, going back 100 to 130 years of data. There are lots of conclusions, lots of data, lots of graphs. There were 3 statistics I want you all to remember which come out of that study. The numbers 5, 3 and 1. 5% real return is the average annual return from equities over those 100 to 130 years.
Does that include income?
Income, total return. 2 to 3% is the average annualized return on bonds, and 1% is the average annual return on bills, short-term money. So sorry, 5 to 1. Remember those figures whenever you're talking to anyone. Over the very long term, equities outperform bonds, outperform money. We know that, it's a fact. You will get periods, and Charlie's pushed up this graph here, when the arithmetic goes astray. You get the black swan episodes. I remember in '87, the big crash stood out in my mind. You know, equities lost 25, 30% overnight in a week. Nobody was expecting it. It blew out all the models. It blew out the longer term, the shorter term statistics, but not necessarily the longer term statistics. Turning to bonds, this graph, traditionally, gilts had been perceived as the safe haven, a proxy for stability, and indeed a lot of the models which IFAs and modelers designed were based off the gilt. The gilt was the default. Equities, commodities, derivatives were all based off that bond. It seemed to me, and quite a few people who were watching the markets carefully over the last 10 years, that QE, quantitative easing, was partly responsible for driving not just UK bonds, but global bonds to extremely low yield levels, or the other way around, extremely high price levels. And the return on bonds between 2008 and 2020 had been spectacular. Gilts were a good part of your portfolio, and in earlier colleagues were saying a good part of your lifestyle portfolio particularly. But it was getting back to my fundamentals, look at the real value. How come gilts were yielding 1% when there was inflation of 8–10%, huge government supply coming up? Something's wrong. And it all came to a head last year. That's where you get that massive fall. I wouldn't expect another 20%, 30% fall this year. Putting it into yield perspective, that would imply the 10-year gilt in the UK would be yielding about 7%, 8%. Now, if you were super bullish on growth.
So, Paul.
Sorry, I can't hear you.
I don't think it's a question.
Oh, right. So
somebody's got a question. Doug Bonner's got a question.
Doug.
By focusing on UK economic situation, are we not missing out on the bigger global picture?
Yes, indeed we are. And when we get to my strategy, which is a good segue now, Charlie.
Hang on.
This is going forward.
Right, future strategy.
Yeah, number one, obvious messages, particularly this year: stay diversified, scale your positions according to your risk profile. Right, next slide. These are my 10. I wrote these January the 1st. And this is how I would structure and have been advising. There were 10 specific points here on asset allocation. And turning to Doug, sorry. Geographically, I would be, and this depends on your benchmark, staying neutral overweight UK equities, not because I like the UK economy, and I can give several reasons why I don't like the UK economy, and that's in the annual review, which I think Charlie's sent to everybody. You'll see I've written at least 10 or 12 points why the UK is in such a mess, the economy. The economy is different from the market, as you all well know. 70% of the FTSE at least is overseas. Large sectors are resources, oil, which are global. Another chunk is pharmaceuticals, which are a bit more resilient to the UK domestic economy. Another sector is utilities. If you add in, what else have we had? Oil, natural resources, drugs, telecoms, you're getting to 50–60% of the economy, of the market, which isn't directly reflective of the economy, which has a number of problems. So I would stay overweight the UK. It worked last year, and so far this year, it's working relative to the world. The other area I would strongly recommend overweighting is the Far East. Now, before China reopened, again, you'll read this in my longer review, I was focusing on other Asia for one reason, and that was largely a better than expected economic growth, more resilience, better fiscal management, lower inflation. And I would add Japan more speculatively because it's a very cheap market. You're getting yield. And I actually think that, and this is my view, that they are going to do something with their yield capping policy over the next few months, which is going to help the currency, and it's going to help free up a lot of regulation and compliance and stuff within the economy. Now, we add to that China, which has reopened. 2022, if you remember, they were looking for 5.5% GDP growth. It came in at 3%. There were three big negatives. One was the very strict COVID policy. One was the meltdown in the property sector, which is very big in China's case in terms of GDP, employment, and property ownership. And then if you like, number 3 was the increasing tension between US and China on export controls of certain products. The COVID restrictions started coming off big time in China on, I think it was January the 8th. And in just 2 months, the data, if you believe it, I mean, it's actually a very timely time because the Chinese People's Congress is starting this weekend, and it's going to be very positive. And not just the words, because we all have some suspicion, obviously, about data and words coming from China, but look at the facts, look at the power usage, look at the number of tourists. Already, PMIs, these consumer sentiment surveys, things are very strong. You don't need to buy Chinese equities direct. You can play it through raw materials. You can play it through certain travel stocks. You can play it through other Asia. So in summary, keep UK overweight, keep Asia overweight. Against it, I would underweight USA. Valuations still rather high. A few headwinds. Within USA, if I was an institutional fund manager for a cautious fund or someone coming up for a pension, for instance, if I've got US bonds yielding 4%, if I've got US equities yielding 1.5%, if I expect volatility in the US equity market, but not so much volatility in the bond market, there's a temptation maybe to say, well, maybe I'll go for the 4, not the 1.5. So there may be, maybe early days, but at some stage, some of these American investors will start pushing more into their own bond market than their equity market. So overweight UK, overweight Far East, underweight America, keep Europe neutral.
Can I make a point?
Yep.
According to John Authors of the Bloomberg, if you're an American investor in the Midwest and the FTSE's just hit 8,000, he wrote an article, John Authors used to write for the FT, he wrote an article saying in US dollar terms, in the UK market, but if you just invested in a FTSE in 1998, all you've done is, apart if you take out the income, all you've done is recover your money. It's flat return for a US investor over the last 24 years in the UK, which is a terrifying
no, within a portfolio, and all you guys will know that over that period, the UK has underperformed badly, and indeed since 2016, the Brexit vote added another reason for it to perform disastrously. It only just started performing relatively well last year, and part of that was the index breakdown.
That's a very much a focus on the UK again. The other point that he made was if the same investor had put the same money into the UK world index, world indices, I don't think they had a world ETF in 1998, but they do now, and they would have trebled their money.
Yes, US growth, Far
in
East.
US dollar terms.
Yes, yeah. Everywhere probably except Japan, that would have been true. Of the major.
What do you say to people like Peter?
Don't forget the US dollar has appreciated massively against the pound. So if they'd invested in the UK market in sterling, in the last 4 years, we've seen a massive depreciation since the 1980s, even bigger depreciations. You have to take that into account. Everything's a statistic. You've got to look at where it come from.
And it brings home the point about global diversification by market and by currency. And when, for instance, we were talking about Japan last year, I was suggesting looking at Japan in a hedged fashion, expecting the Japanese yen to weaken against the pound. It did precisely that. And anyone who held an MSCI sterling hedged ETF substantially outperformed anyone who, for instance, had the Bailey Gifford Japan Fund, not hedged. So Bob's comment about the currency is very valid. And from time to time, the currency can affect the underlying investment. It can affect the companies because they're exporters or domestic producers, and it can affect the investment of the currency of your investment, and you can choose to hedge from time to time.
Do you advise IFAs to use hedged ETFs or non-hedged?
Well, you have to take
back into UK pounds, obviously.
Yeah, if you're being ultra cautious, you could say, and your clients and everything was sterling based, you could say hedge at most times. I was suggesting that Japanese view because I was taking an active decision on the sterling yen. So you could either say hedge at all times to be very cautious, or take a decision yourself. You think the pound's going to go stronger against the yen or weaker, or weaken against the dollar. And remember what I just said, hedging the currency movement can also affect the underlying index through having, for instance, a large export component. UK is a good example. Knee-jerk reaction when sterling weakens, one of the immediate reactions is FTSE tends to strengthen, and that's because of the 70% of the index which may be dollar orientated. So take the dollar into the currency into account. And if you carry on my 10 tips for this year, we've talked about the countries, UK, Far East, and so on. Number 6, the dollar has been very strong. My feeling is that this year the yen may surprise. That's the yen strength rather than the yen weakness, and the euro may come into its own. So don't just keep all your spare cash in dollars. It worked last year. It may not so be easy this year.
Somebody had a question.
Yep.
If there's no question, we do need to push on.
Yep.
Time scales wise.
Yes.
Can you wrap up this slide and we can move on to the next one?
Yeah. I mean, there are other themes here. Number 10, we talked about fixed interest. Some very cautious institutional life funds, pension funds may start looking at gilts again for the reasons we've just discussed. 4% is better than 1%. I am starting to increase fixed interest weightings for some more cautious clients, but not through conventional gilts. I'd look at corporate bonds. There are a number of good quality UK-based corporate bonds now offering 5 or 6% in a year in sensible maturities. So picking up 5% a year income with something which matures at 100 in a few years' time, perhaps isn't to be sneezed at for somebody who's...
And for IFAs who are sometimes anxious not to buy individual preference shares, can you recommend any pooled funds?
Yeah, there's some preference shares, a special class, and there are 2 stocks I like in particular. I won't go into them here, but they're yielding 6.5%. Definitely no problem with default. But if you look at, for instance, the Shire Investment Trust, 30% of its assets are in preference shares, and they're bog standard names, Lloyd's, Ecclesiastical, Aviva, all names you're familiar with. These preference shares are paying 6% a year. That's a reasonable income, I think, in this environment, although inflation is still 10, but 6 is better than you might be earning in your bank. So gradually start building up the fixed interest, but I wouldn't go gung-ho on gilts at the moment. The big difference between the gilts and these other stocks, apart from liquidity and so on, is the supply. And we have to remember there's going to be an awful lot of gilt supply from Rishi and Hunt over the next few quarters. Nothing else really on that page. I prefer value to growth. This was one of the themes last year. I think it will continue. I'm starting to look at selective small cap stocks and investment trusts related to small cap stocks. And within the mining sector, very specialist. I do like uranium as one of the longer term plays. So those would be 10, and obviously renewable infrastructure, but avoid greenwashing. There are quite a few nice investment trusts, 2 of which have produced figures the last few days in wind and solar, trading near asset value, strong balance sheets, paying 6%, 7% coupons, low correlation with the underlying market. They're ideal for a pension fund or a SIP or an ISA. So that's those are my forecasts. What was on the next slide, Charlie?
The teaching point for the quarter.
Yeah, if you go back to the very first slide, or the second slide, Charlie, with my bio, number 2, I think it was.
Number 2. There you go. Your biography.
Right.
Formerly Associate Director of Legal and
Right.
General.
Well, the broadband must be disappearing here, but I can try it from memory. When I started City career with Touche Remnant, it was an investment trust house. I got involved in, first of all, investment trust, junior manager, assistant, and so on. Main brief then was to outperform my peer group, which was defined by the AITC, which I don't think exists anymore. But my job and my pay and my bonus was based on that. I then started looking with Legal and General at Life Fund, and my benchmark was the FT index plus 2%. I had to outperform the index by 2%. I did that annually over 15 years. My benchmark was the index. I also managed some pension funds. My benchmark then was something called a Wood Mackenzie, which I think became part of Wyatt, but it was a peer group, competitors. I would pitch for business saying, this is them, it's Touche Remnant. This is our fund, this is the median performance, and all the other reasons. I then moved more towards private client stuff, early 2000s, and the first thing I noticed was your clients typically were more interested in what I call real money rather than relative money. Now, what do I mean by that? In my institutional days, market as it was one year could be down 28%. My funds would be down 25%. I get paid a bonus because I've outperformed by 3%. My benchmark, my brief was, in that case, the index. That, of course, is a very hollow statement to a private investor now who's just lost 25%. But my point is, you've all got different benchmarks. Some of you may be saying, my client only wants to make money, number one. Some may be saying, my client wants inflation plus 2%. Some may be saying, I want to beat the benchmark. I want to beat interest rates, so what I get in the bank. Some may be saying, I want to beat FTSE. Some may be saying, I want to beat MSCI. Some may be saying, I want to beat TrustNet, Micropal, ARC, if it's still going, FTSE Private Client Index. So there's at least 10 indices. And how many of you are out there today? I can't see, but probably 10, 20. I've got 10 or 20 different benchmarks there. So it's pointless me saying to you, have X% in America, X% in what. All I can say is overweight, underweight, relative to your benchmark. Understand your benchmark, tailor this strategy around it. So that's all I have to say today, Charlie. I hope it's been useful.
The problem for IFAs is that the advantage they have is they give advice. So generally speaking, we advise on which benchmark to use, which then lends the tremendous opportunity to change the benchmark as things go along.
Well, unfortunately, that happens, and it must be a bit galling sometimes for the end investor to see not just the question of with and without fees and changing benchmarks, but that's your job, and you've done your due diligence, and you know what your client wants.
The benchmark should compare apples with apples, not apples with bananas. And so many people have benchmarks that bear no relationship to what they're actually investing in. And that's where I think the ARC benchmarks come in quite well, because for global investors, they are showing the returns from global portfolios that have similar asset mixes, not a 60-40 or whatever. It's actual returns from actual fund managers rather than the stock market return or the S&P 500 or whatever.
Yes, Bob, that's true. But what happens in a year when, if you like, the whole peer group sort of gets it wrong relative to the index? Is there still a satisfaction?
That's the point of measuring against your peer group. You're measuring against what you're investing with. Your peer group is who you're investing with. It's what your colleagues and competitors' clients are receiving by way of returns. A benchmark is a very, using an S&P 500 or a FTSE 100 is an incorrect way of comparing, because you're not comparing an asset class that is in a similar fashion. S&P 500 or the FT 100 is a pure equity index. We invest our clients in a mixture, and we use active fund managers to further diversify. So you need to be comparing like for like.
But interesting, if, for instance, you've got some cautious clients, Bob.
Yep.
Are they more, say, cautious clients near retirement? Are they more interested in a peer group, which can get it wrong relative to an index, or are they more interested in beating inflation, beating the bank accounts, making money for retirement?
Well, they're more interested in capital preservation and maintenance of income. So what goes on around them, they're not that bothered about in that respect. It's actually
so a cautious peer group then perhaps isn't so appropriate for them.
Well, they'll be invested in line with a cautious peer group anyway.
Yeah. Now, I think this is interesting. Some very interesting points there. And I know some people, for instance, who have different levels of benchmark according to the risk profile of the client. For instance, an ultra cautious client may not have a peer group benchmark at all, but just say, I want to pay my bills, I want to beat inflation. Number one. The other end of the scale, your growth investor, typically younger, more adventurous, whatever, might be saying, I want to beat S&P, or in your terms, want to beat the peer group of growth investors, is what you're saying. Mm-hmm. So you may tailor the benchmark according to the risk profile.
Mm-hmm.
Good. Well, any other questions before we? I'll circulate minutes after this. So we've got some, and obviously the slides. So
just to maybe generate a bit of conversation from you guys, if you like, in an economic sense. The UK, I'm talking specifically here. I'm looking at the headwinds to consumers' expenditure in terms of the let's say utilities, council tax, strikes, telephone bills, inflation, food inflation, 15%, falling house prices, collapsing car market, insolvencies rising, according to Begbie's trainer. And it's possible to be, as the Bank of England is, quite negative or flat on the UK economy. I look at what's happened in January, February, and IAG, Ryanair, Premier Inns, retailers going through the roof. What is the audience's perception of the real economy in the people you talk to day to day, and cost of living crisis and headlines, compared with what the economics tell me. Anyone want to say anything?
Well, if nobody else is going to say anything, don't mind chirping up. I think there's a lot of money around, and it's 100 times easier to be negative, and it's very often it's sloppy thinking, and just reading the papers, you know, one disaster after another, and isn't this bad, and so on. But generally speaking, I think we've never lived in a richer age.
Well, why are Begbie's and Ernst Young saying insolvencies are up 80%? Why did Persimmon yesterday saying we're very depressed about the house building?
Well, they always do. It's a bit
why
like
is the car
retailers always blame the weather. Every annual report you ever read, they say, "Oh, well, the weather's been bad, so it's affected sales." I mean, it's almost like a standard paragraph.
But companies are going bust.
Property,
80% more companies are going bust. What's that a sign of?
Well, parochial thinking.
Parochial thinking, the reason they're going bust.
Okay, I'll put another point to you, which is, if you take the last 6 months from September to December.
He agrees. Sorry.
From September to December, the market sort of generally declined enormously, and there's nothing really different. And then they shot back up again, and I find it amazing how there's no real difference in the economic situation. Information, not that much difference. And it's just sentiment driving it down and driving it all the way back up again.
You're getting to 2 points. My point originally was talking about the economy. Now you've gone on to the market. And in the UK sense, the economy is very different from the market. So my question was, the economy is not in good shape. Market could do all sorts of things. As you said, some of it's sentiment, some of it's overseas, some of it's oil and gas, which unfortunately is down to Russia, Ukraine. You know, there are other factors, but the economy. I mean, one factor, if I play devil's advocate, I personally think that COVID has put a certain amount of extra money, legally or slightly illegally, into consumer pockets and corporates as well. But that's just my view on where some of this hidden spending may be coming from. And secondly, and this is a psychology thing, there may be an element of consumer catch-up. They call it revenge spending. We have to go on holiday this year 5 times. We have to fly. We have to get away. We have to go out to eat. We have to go out to dining 5 times a week or whatever. It might be true. There might be a sort of psychological sentiment thing there. But, this has to be paid for. So different views.
The 80% number of more bankruptcies in this year is what time period are we talking about in comparison to?
They're talking about if you look at Begbie's, which is actually one of the companies I like investing in because they specialize in insolvencies and businesses going through the roof, and Ernst Young, it's the last quarter of 2022 compared with the last quarter of 2021. So year on year.
Yeah, so 2021, there were thousands of companies being kept afloat on the back of COVID payments, et cetera, et cetera. Their staff were being paid not to work, et cetera.
Correct.
And an awful lot of that was false information. So you're taking a period where no companies were going bankrupt because they were being supported by the government, to a period where everyone's on their own and having to do their own thing. So those companies that were going to fail anyway have failed now instead of then.
And they're laying off people. They're laying off people. They're losing jobs. They're going bankrupt. That can't be good for the smaller company economy.
But if they're going bankrupt, it's because they're not profitable businesses. So it's the natural sequence of events, and that's what, unfortunately, COVID hid that because the government.
Yes, no, you're right. But the fact that there are more people going to be hitting the job market, there's unemployment, there's what goes with that. Is a fact. And I think individuals as well who've taken out COVID loans. I haven't seen the figures on this, but some of these have got to be repaid. So there was you're right, there's a masking which COVID, and that's a global feature as well. You could say far too many zombie companies were kept going too long, partly because of quantitative easing, which kept the the long bond yields very low, and partly because of COVID, government measures to keep people and companies propped up. Both of those props, COVID and interest rates, have been taken away. That's not good news for a lot of people or a lot of companies.
Okay, thank you, Ken. It's 11 o'clock, so we've completed our hour. And thank you, everybody. If there's any other questions, by all means, email me, charlie.palmer@ifac.eu. And like I say, we'll circulate the minutes and slides.
Yeah, and if anybody wants any help with individual stock lists, which we didn't get onto in this forum, or portfolio reconstructions or any clarification, my email is at the bottom of the presentation. Thanks, everybody. Bye.
Okay, thank you. Good, Ken. Good to see you again.
Right.
Bye, Charlie.
Bye-bye. Thank you very much.
Thank you.
Okay, cheers. Ciao.
Thank you.